Welcome back to the Generational Investors Podcast, where we explore the timeless principles of building lasting wealth. I'm your host, John Woodard III, and we're back this week with our favorite guest, Mr. John Woodard, our president. And this week, we're getting into talking about gold and silver, specifically the history behind it, what's going on right now, and just also how investors can position gold or silver in their own portfolios. And to begin, just another thing of housekeeping is don't forget, if you have questions or topics for new podcasts, please email us at podcast@wcamg.com. And so just to get in the episode here, we'll just talk a little bit about gold. I'm just going to give a few little current data points, and then I'll let you go into the history and everything of it. But beginning off right now, as this podcast is being recorded, gold is around $5,150 to $5,200 an ounce. Silver is around $86, $87 an ounce. Gold hit a high earlier this year at about $5,600, and silver was around $121. So they've had quite some volatile fluctuations, but they've also, they've had a run up. Silver was up 200% or so maybe last year, give or take. And gold also had a run that was almost in the triple digits. I could be a little bit wrong on that, but crazy big run ups over the past few years. And so anyways, just to get into it, gold, really what it is, silver, what it is, what it's been used for. Gold, they don't produce any earnings, dividends, or any sort or cash flow, but they're rather instead used as a safe haven during terms of interest rate changes or global economic tensions, as we've seen over the past few years.
And historically, inflation was that was the basic reason you purchased gold as a hedge against inflation. But that's changed, and it does not provide that hedge now for some reason. It's obviously done well, but for example, in I think it's 2022, when inflation, we had some of the worst inflation in 40 years, gold was flat that year. And then we used to see world tension. You'd see an event back in the 80s. It's the Achille Lauro. It was a ship that was taken over by Libya and so forth. Well, we sent jets in, and gold just spikes up, and gold is a hedge against that kind of thing. But now we see events like that, and gold doesn't seem to react. About the only thing gold seems to react to is a dollar weakness. If you were to look at the sovereign wealth funds of nations, they have to, if they have a trade deficit, if we have a deficit with their nation, they need to buy U.S. bonds, or typically that's what they do to put money in dollars. And when you put money in dollars, if the dollar's weak, you're going to lose money. And so you could put in like 10-year treasuries yielding 4% now. But if the dollar drops 10%, you get a negative net yield. So gold is now the hedge, and that's why you see it being purchased by central banks and China and so forth. And it's kind of changed. But
for the first time in 30 years, gold is now a heftier reserve asset than the U.S. dollar across central banks.
Oddly enough, yeah. And when I started in the business in the 70s with E.F. Hutton, gold was trading just a couple $100 an ounce. And by 1981, we had inflation, and this was, we had terrible inflation. Gold hit $800. It didn't get back to $800 until December of 2007. So if you had held onto it, it was nearly 30 years. Now, in the meantime, the stock market was going up. You were making money if you put money in bonds, or you put money in Duke Power stock. You made a lot of money. Gold did nothing, and so you got to get gold right.
That's a fascinating aspect, because if you look at people who talk about gold, a lot of times they're talking about it throughout like the past 100 years. It's averaged 5 to 10%, which is the stock market's also done 10%. But you don't see stock market didn't have the U.S. stock market has not had a 30-year deficit where it took 30 years to get back up to what it was. With some stocks, right, like Cisco, for a chance, and it just reached back to its all-time high back in 2000. That's an obsolete example, but
during the dot-com bubble and in 2000, Cisco was trading at 75. Well, it's at 75 now. Well, that's 26 years ago. So
that's rough.
That's
individual stocks, but stock market. How long did it take, like the Nasdaq, to recover from?
Well, the Nasdaq was trading in the 600s, and what is it now?
It's at now 21,000.
21,000. Yeah. Oh, excuse me. It's trading. I'm sorry. It's trading around 4,000 now.
Okay.
21,000. I was doing the S&P. The S&P went down to 666, and is now at 6,800.
Yeah.
Roughly. So, but yeah. And you were saying, gold, something to think about. Companies develop new products. They have earnings. They pay dividends, all these things. Gold is just a hard asset, hard metal. It like you said, it produces no dividends. It doesn't pay interest. It fluctuates. But also something to consider. It has a depreciating quality to it, in that if you hold gold, if you take delivery, you have to have it reassayed before. Okay, well, there's a cost there. Or if you don't hold the gold, if you leave it, there is a storage fee. So you can see. If I would make the argument too that if you are in gold, and it's been a wonderful asset here the last especially since last August. You got to get it right, because so much of what's happening right now in the economy is fundamentally sound and solid for the U.S. economy. Mm-hmm. Well, that kind of thing leads to a stronger dollar. And so while this administration has, to help our trade and so forth, has wanted a weak dollar, at a certain point, there's nothing they can do. This dollar, in my opinion, will firm. And as it does, they don't need the gold reserves. The foreign countries won't need the gold reserves.
That makes sense. And also, just from what you're saying about storage costs and all those different costs associated with holding real gold, it seems like if you're an investor in gold, it'd be almost just the smartest thing to do is buy like a gold ETF or potentially a gold miner stock or something like that.
True. There's so much emotion though right now around gold that people just, because it was trading at $1,800 an ounce just in October of 2023. So just a little over 2 years ago, it was at $1,800 an ounce. Right now it's $5,122. But if you looked on the 29th of January, which is 28 days ago, right? Yeah. It hit $55.86. Well, like I said, it's a little over $5,100 an ounce now. On February the 2nd, okay, once again, after hitting $55.86 on the 29th of January, on February 2nd, this is intraday high and intraday low, it dropped to $44.23. So it dropped over $1,000 an ounce, and now it's rebounded to 50. In the middle of that range. Silver last August, actually you could go last April, trading at $29 an ounce. Last August it was $36. It hit $117 on January 26th of this year, and now it's at $85. So
way more volatile than people would expect. If you're not really watching it day to day, I mean that's.
Mm-hmm. If you were to look at silver, that's down about 35%, 40%. It's like Bitcoin. We saw Harvard University bought it at $120,000 a coin, and it hit $63,000 the other day. They literally have lost almost 50%. And they bought it.
It was like $300-400 million of their endowment.
It was $240 million, I believe, and they bought it at the end of last year. So you sure wouldn't want it. I'm just saying, there's nothing behind Bitcoin except for other people coming in, and it's purely just called Ponzi or something. Anyway, but it is a means of moving money. So I'm just saying, if you buy gold, at some point this economy fundamentally it's changing and it's becoming more solid, more sound. Mm-hmm. The dollar's been weak, no question about it, but that is about the basis and the only thing that you can.
Just to go back briefly, talk about why gold and silver went up all the way in 1981 to those highs that took 30 years to rebound. Well, if you could just.
That was inflation. That was, once again, for thousands of years, inflation was the reason. you bought gold because it provided a hedge against the rising prices. And then you had a period where okay, it really, when it became a currency, more currency focused, was in 1994. It was called the Maastricht Treaty, and it was when the euro evolved. And if for example, if you bought all the European currencies, the franc, the mark, the lira. Let's say you bought Italian bonds. When they closed, when they went to the euro, when they closed trading on those bonds, the interest rates didn't go up, didn't go down. The next morning, you had 10% less of your net worth if you had Italian bonds, because their currency was devalued by 10% overnight. And so we actually, Woodard and Company, we bought gold. I was looking at that, and we bought gold. We made a killing on gold right there because we knew that the contraction in currencies would cause gold to spike, and it did. Yeah, you can pull up our trades, and so it's an event. I don't see those events. We saw China's worried about the yuan. They're trying to shore up. Historically, China's wanted a weak currency because they want to export. They're trying to shore up their currency. I think they're concerned that it's growing worthless. Well, in that case, what do you want? You probably want gold.
Yeah.
It's not all dollars. There's other currencies in the world. So gold, and that's why you're seeing all these central banks just load up on gold. There's a lot of disruption in currency valuations now.
Is there anything you would say to investors trying to look to position gold in their portfolios right now? Just maybe how they should look at it, or what the position should be?
Yeah, I think you're fine. Obviously, you've been fine. So, certainly, like I said, I saw gold when I started in the 70s at $200 an ounce. You can go back to Bretton Woods when Nixon up in New Hampshire took us off the gold standard, which I believe is a mistake. Our currency, the dollar, was based on gold. That's going to something else. But I think that you really, if you're a gold bug, you really need to watch currencies. And when you see dollar stabilization, and then if you could see stabilization in other currencies, then you're going to see gold sell off, because the central banks will start dumping it because they don't need the hedge.
That makes sense. Okay, great. Is there anything else you'd like to add on just to finish off with gold? I mean, it's something. And one other a point I'd like to make too is that gold and silver, they trade somewhat next to each other, but sometimes they fluctuate a little bit more than the other. But silver can also be used as a industrial metal. It's used a lot in solar.
Right, gold is typically not that.
Yes.
Well, okay, then I would say too, look at copper. The demand for copper for the AI, for the chips and so forth. The stock Freeport McMoran, which we have in our portfolio. Look at steel. Look at Nucor, another stock we have in our portfolio by way of disclosure. With the reindustrialization in the United States, and potentially the reindustrialization of Europe and portions of it, I think you're gonna find the demand for steel, the demand for copper, and a lot of metals, and so I think gold is just that. It's just that currency hedge, and so if there's not a currency situation, you're going to see it do like it did from 1981 until 2008.
That's unreal.
And it went down. Like I said, we talked before. I was with F. Hutton, and the company above us was a company called Bache, a famous brokerage firm that no longer exists. It's one of the top 3 or 4 in the country in 1981, and the Hunt brothers cornered silver. And if you've heard of the book The Silver Bears, they ran the price. They bought all they could. They squeezed the price up to I think $45 an ounce, something like that. And then there was no buyers for it, and that's when you get a commodity, when you get a lack of buyers, the commodity has the glide path of a brick, which is straight down. And so, and that's what
didn't
gold
recover till last year.
Yeah, like I said, gold went from $800 to $200 an ounce, and it stayed there for years and years and years. And like I say, did not touch 800 again until like late 2007, early 2008. So
It's unreal.
anyway,
Well, thank you. I learned a few things, and it just definitely there's a lot to talk about with it, and it's good just to keep it in mind because it is an important component of just the economy these days and what people are looking at. So that rounds up today's segment with our gold and silver talk. And just to finish off things with John's pick of the week, we're talking this week, and you can speak a little bit on it. My favorite book, it is called Meditations by Marcus Aurelius. It was written by Marcus Aurelius, who was a Roman emperor back from 160 to 182 or so AD. So about 1,800 years ago, but it's still the principles that come into it are still applied to today. And so Stoic philosophy, he's one of three main Stoics, is him, Epictetus, and Zeno. Zeno was the first of the Stoics to really come about. I can get more into Stoicism later down the line, but he essentially was on a boat with all his goods, and a storm hit him, and he lost everything, and he just kind of realized that, that's past. The only thing I have is the present now, and I must move on and enjoy life. And so that's what Marcus Aurelius, this book was originally written as just notes to himself, just to improve and remember that life is a gift. The quality of the happiness of your life depends on the quality of your thoughts. That's one of his quotes in there. But also just remember that you must die. That's one Stoic Latin quote. They always say memento mori, is just remember you must die. So just death is inevitable, but to live every day the best you can.
Can I make a comment?
Please do.
So I was given the book when I was 12 years old, and so I wanted to give it to John. And Marcus Aurelius was, once again, he was a Roman emperor. He had the whole world. They literally owned just about the whole world. But he lived a very modest life. He didn't do the wild stuff you hear about the Romans. He lived very centered, very, very ethical. He was a very fine man. And he didn't give into all the excesses that
temptations
and the
across
temptation
the
of
board.
the period. Yeah, he lived very, very modestly, and he was also a great general. So.
And in those times, the people would be drinking until they puke, and then drink more and eat more, and I guess people still do that these days. But he had everything at his fingertips that he wanted, but he just instead decided to live just as he could, as a better man.
Modestly. Yeah.
And one of his other quotes I like is that you have power over your mind, not outside events. Realize this, and you'll find power, find strength. And was something that just he a good thing is just you take responsibility for everything in your life.
And he contrasted so much because of the other just debauchery of the other emperors like Nero and so forth. But there's a reason why, if you watch Gladiator with Russell Crowe, Russell Crowe's the leader of it was Marcus Aurelius, and his son was this evil guy. I don't know if that was the case in real life, but I suspect it might have been.
His son wasn't a good individual.
But Marcus Aurelius was this fine, good man, and he really was. It's a wonderful book, and I think it's a great book for young men to take to heart.
It takes a little bit of reading and rereading just because it's translated from Latin from all that time ago and whatnot, just to fully understand it. But it's a good book. It just, for a person of any age, I believe it just teaches living in the present, just taking personal responsibility for anything, just realizing that you have
being honest and ethical and just doing the right thing. And
it's great. And the whole line of Stoicism kind of goes from that. Seneca's the other one. Epictetus is also in the bunch, but Zeno's the first one. Anyways, so that rounds up today's podcast. We thank you all for listening. As always, we like to end with the good old motto that we have. Now officially a registered trademark, as we had some issues in the past, but always buy quality and diversify. Thank you. The information provided in this podcast is for educational and informational purposes only and does not constitute investment advice or recommendation to buy or sell securities or an offer or solicitation of advisory services. It does not take into account your individual financial situation, objectives, or needs. Investments involve risk, including the potential loss of principal, and past performance is no guarantee of future results. Woodard & Company Asset Management Group is a registered investment advisor with the SEC. Please consult your financial advisor or tax professional professional before making any investment decisions.